Hello and welcome to today's session. My name is Steve Kuiper. I'm the head of marketing at Ordway, one of the sponsors of today's webinar, along with Spendflo. And we're thrilled that you've taken some time out to join us for this 1 hour session where we'll be talking about the SaaS triple play, which is how finance organizations can achieve profitability, cash flow, and growth in the second half of 2023, which is, I know, a topic that a lot of us in the SaaS and cloud space are wrestling with. I'm going to introduce our other panelists here in just 1 minute. But before I do that, why don't I cover a couple quick logistical housekeeping items. We are recording today's session, as you probably noticed, and our friends at Spendflo will be putting together a replay recording of that in the next couple of days, which we will send out to everybody that registered and attended. So if for some reason you need to leave the session early, or you have a colleague you think would benefit from listening to the replay, that will be available to you. Let's go ahead and do introductions. And Stephen, I'll start with you. Just, if you wouldn't mind just giving some context frame of reference for the audience about yourself, a little bit about your background, some of the clients that you work with, some of the things you advise them on.
Sure. Yeah. So I've kind of worked in different finance roles, whether it's at nonprofit organizations, Fortune 500, or startups. So I've kind of seen a pretty wide spectrum. And most recently, I've been really supporting a portfolio of startup companies at my current company, Growth Lab. And so we're just going in, helping give guidance and kind of do forecasting and projections for them. And that is where I've spent most of my time is right in the weeds with a lot of startups over the past few years. So.
Great. Well, we're looking forward to learning from some of your insights and experiences with those clients here in the session today. Next, let's turn to Rob Banky, and just in full transparency for everyone in the audience, Rob does do some work for Ordway as a fractional CFO. Just wanted to share that. Rob, but why don't you go ahead and tell us a little bit about your background and some of the clients that you work with.
Yeah, absolutely. Thanks, Steve. So early on, started my career with Deloitte, spent about 4 years there, actually ended up going to law school after that. Didn't love being a lawyer, so I left and went into financial consulting, worked on some IPO transactions, ended up working for one of my clients, taking them public on the NYSE, and then since then have been working kind of in technology startups for the last, we'll say 15 years, and have a consulting practice to help early stage startup companies kind of get from the initial product market fit to starting to scale and getting to the Series A and Series B rounds. And been doing that with me and my team, and do full service accounting and fractional CFO work, including for Ordway.
Great. Well, thanks for taking time to spend with us, Rob. So let's go ahead and jump in. But before we jump into any one of those three areas, though, I wanted to talk just at a high level, this idea of balancing growth and efficiency that everybody's talking about. We have a lot of finance operations folks on the call that are data metrics driven. Help us quantify that. Like, what does success look like? If you had a goal for 2023, or maybe even you're starting to think about 2024, how do you know what the right balance, what the right mix is? Do you think of each of those three things individually? Are there metrics that sort of combine them in interesting ways? I'm interested in both of your perspective on this one.
I can take it first. Yeah. I mean, I think what a lot of people default to is generally the rule of 40. So historical metric used by a lot of the VCs and venture capital, developed by looking at historical trends of public SaaS companies since like the 90s. The idea was that you can, as long as you hit the rule of 40, which is your growth rate minus your or plus your net profit rate. So let's say you're growing at 40%, but you're losing 10%. Then your rule of 40 number is 30, so you should be a little more aggressive and either cut that down to get to zero profit and loss, so break even profit loss with 40% growth, or get to 60% growth and like a 10% loss. So as long as those two balance out, you're on trend. Now that is true for, I would say, mostly later stage companies. As you get to the 5 million, 10 million, 50 million ARR marks, like that's where you want to be targeting. It's pretty tough to do that at the early growth stage, especially if you're investing a lot in R&D and capital there. And it's just like perhaps your G&A isn't scaled out and you can't quite get the fraction to work out on that. But I would say that's the primary metric that most people look at. I don't know, Steve, Stephen, what are your thoughts?
Yeah, I would agree with everything you just said, Rob. I think I've seen the same thing with early stage startups. It can be like some of the rule of 40, even the fluctuations from like quarter to quarter, when you like do the math on it, it can be pretty wild, just depending on the growth rate and, what investments are being made. One area that I've seen have a more renewed focus, at least over the past couple months for a lot of my customers, is the idea of just kind of the back to basics, like the unit economics, and are we even profitable with our pricing, and at the unit level, like every software license we sell, how profitable are we? Are we profitable, or are we kind of underwater on that? And so that's been another one. And I think the underlying idea behind that is, if your unit economics are right, then that's usually going to drive to increased cash flow over time. Not always, but that's the idea behind it, depending on what your G&A investment is. But that's been another one that I've seen have a lot of focus here more recently.
Yeah, that's actually a great point. Like, I remember one of my previous companies hadn't really looked at the unit economics on a pricing per kind of, we had three package deals, like, your small, medium, large, good, better, best type pricing. And when we actually did the fundamental analysis on each of those, it turned out like that good deal was just like, we were losing like tons of money. So we like just shifted to the right. Essentially, the good became the good, the better became the better, moved it down a stack, and then put a new one in the end, and actually like turned around the company and the profitability margins, because people were still buying the lowest tier, but the lowest tier was now profitable for us. And if they upgraded, then all the better.
I think there's a lot of, not to go off on a tangent, there's a lot of insight into evaluating pricing at the second half of this year, I think.
Okay, good. Well, let's go into the three different areas, and I thought we'd start with profitability first. Maybe just again at a high level, when I think about improving profitability, I think about expense reduction. So maybe you guys could just give us your perspective, all the different SaaS and cloud companies you work with. What are the top 3 or 4 kind of expense categories that you see? Is it travel? Is it real estate? Like, what would you say the top 3 or 4 are?
The big 3, I think, will come probably to no surprise to everyone on the call. It's headcount is by far the biggest one. I typically see, this is going to range, but I would say somewhere in that 60 to 80% probably of total costs. Obviously, it's going to depend on industry and everything, but that's typically what I see. And then cloud spending, you've got to have AWS or Azure or one of these systems to support whatever platform. If you've got a SaaS platform, you've got to support that. And then usually SaaS spend, all the different subscriptions, and as we know, there's a subscription for every single thing nowadays, and so those really start to add up on the P&L. I would say those are by far the top 3 that I see. Maybe a 4th one I'd add in there is professional services. If you need a fractional CFO like Rob, like, that stuff's got to be included in there, or fractional CMOs. There's a lot of fractional work, I think, bubbling up these days in startups. So those would be really my top 4.
Rob, how about you?
Yeah, I mean, definitely agree on the top 3 there. I mean, I also agree on professional services. Like, I think legal can always want to keep an eye on that one, because their bills can get big, and they can get big really quickly, and just kind of unexpectedly, and make sure that you're kind of keeping an eye on that and not going down a rabbit hole or spending a ton on patents if it's not top priority. The other thing I'd say is digital advertising. Like, I think you got to monitor your Facebook, Google, LinkedIn spending in general, because again, it gets put on auto charge, like you just recurring, you see it all the time, but making sure that you're always analyzing whether it's effective and you're getting the ROI that you're putting into it. Like, again, in previous experiences, like sometimes you're spending a lot on like a keyword that isn't actually driving leads. And as far as like other things, long tail, real estate, I think, a lot of people have gotten rid of their real estate since the pandemic, but then I think there's a trend to starting to see some of that come back. And does it make sense to go into a co-working space and have an office there, or do like meetups? A lot of people are meeting up as opposed to having an office every day, but then that adds to cost that align along with travel and entertainment, I think, are also expense drivers.
Yeah.
You sort of have some natural forces against travel and entertainment these days. You can't even get a flight without it getting canceled. So,
Or you get trapped somewhere and then you have to spend extra.
yeah, more
yeah.
on hotel bills. So you guys both mentioned headcount was probably the top one. So in terms of thinking about whether you're spending the right amount on headcount, given that it might be 60 or 80%, what areas do you look at in terms of right sizing? Is it G&A? Is it R&D? Is it sales and marketing? And how do you know what the right level of spending is? Are there any kind of benchmarks or things that you consider? Rob, maybe you start us off this time.
Yeah, absolutely. So I would say like one is know your benchmarks. There are a couple different places to get it. KeyBank, I guess whoever acquired them these days does their annual SaaS survey, so that's publicly available. There's some good platforms out there that'll give you some benchmarking metrics. Or I'm sure if you're VC backed, I'm sure your VCs will give you that information for maybe their portfolios, or maybe they have some broader market information that they're willing to provide. Keep in mind that it does tie to revenue tier, so making sure that you're looking at your revenue tier, and if you're between tiers, making sure that you're aware of both where you currently are and where the next tier is, so that you can see how that trends over time. I would say the other big thing is with headcount is making sure that if we're investing in people, making sure that whatever they're doing is returning an ROI to the company. I've kind of taken the approach recently that like, does this lead to new sales or more efficient sales? Does it improve the bottom line? And if not, maybe we don't need it. Maybe we need to reinvest that cash somewhere else and really drive ROI, given the lean times we're in overall in the market.
Steven, anything you want to add on this one?
No, I just would reiterate that point. I think this is a fantastic time to kind of go top to bottom, on the P&L, and even through headcount, and say, are there areas we can be more efficient without losing substantial value? I think this is just a great time to have that kind of evaluation.
Yeah, and kind of adding on to your last point there. So it's hard to have a day go by where you don't see some big headline about, I think there was something from Insider today about like an extinction level event for startups, or Darwinian event or something. You hear a lot about the layoffs, but one of the questions I had for you guys are people still hiring selectively? Or do you see them just have a complete hiring freeze, or are they looking selectively, saying areas, kind of the way Rob was thinking, we're really getting a lot of ROI from this particular function or from investing here? Are they backfilling employees as they leave? Like, how are they thinking about new headcount? Steven, maybe you start us off on this one.
I've seen this be, this may not come as much of a surprise, but I've seen this be completely correlated to how much cash is in the bank. And so if I've got one company in mind that I've been working with, they have great cash flow, and they're full steam ahead. No major changes to their hiring plan. In fact, they're trying to. In fact, if you've got a rich balance sheet and a lot of cash, it's a great time. There's all kinds of talent out there that you can go get right now that can kind of take your company to the next level. But on the flip side, I also have some companies that maybe raised 6 months to a year ago, and they just, every forecast we do, it's the cash balance is just down. And so they're more in kind of that protection mode of, if someone does leave, it's much, whereas before it would have been like, yeah, we got to go post the job. We've got to go hire for this immediately. Now it's a little bit of a pause. Let's hit pause for 30 days. Let's evaluate. Can we share the responsibilities? Do we really need a backfill right now? So I would say it is all over the place, but it's definitely correlated to how much cash is in the bank and the underlying fundamentals of the business.
Yeah, I totally agree with that. I would say that I've kind of seen a trend during the year, which was at the beginning of the year, almost everybody defaulted to hiring freeze, do cuts, kind of as a trend, like everybody in the market was doing it. Nobody wants to stand out as they're the only ones doing it, because then you get kind of a bad reputation. But as everyone else was doing it, everybody took the advantage to trim the fat. And since then, I would say that I totally agree with Steven's point on this. Like, depending on where they are with a company, depending on the fundamental unit economics, like if the unit economics are good, that company is hiring. That company is still out there, like looking for the right people. And I think it's a great time to find talent. If the unit economics are okay and you're going to break even, like I think people are stretching. I think, I see a lot more like, if there is somebody that leaves and there's a backfill, you have to justify the backfill. It's not an automatic, like, let's get that person rehired. And we, of course, we need that person. The question, the starting assumption is, well, if they're leaving, do we really need that person? How can we spread out that work? Is there work that we're doing that we don't need to be doing anymore? And we can, shift stuff around so that we're not burdened with that headcount cost.
So are always fun conversations. I want to come back to something that Stephen brought up a few minutes ago, though, on the expense, top 3 expense areas. So you mentioned software and SaaS expenses. And I think that's something, it's kind of, it should be obvious to a lot of us that are on the webinar today, because we've all kind of benefited from the growth in SaaS, but, often it's sort of at a departmental level budget, and you don't realize how much as an organization you're spending on it. I've definitely had that experience you were referring to. Like, there's an app, it seemed like every meeting I go into, when we need to solve a problem, let's go buy some new piece of technology is the answer. So Stephen, though, I know you've done a little bit of work on this. Like, how do you get your arms around all the different SaaS applications that people are running, right? Because you got a product like growth now, people go out and just sign up for stuff. Finance doesn't know, no one has to approve it. Like, and then once you have that list, like, how do you go down, narrowing down like where you can cut?
Yeah, one of the great things about how a lot of SaaS pricing is done is it's usually under like a threshold of approval. It's usually like, it's $89 a month, or not all the things, but a lot of different softwares are, and so those things do start to stack up over time. What I have found, and even in organizations I've really been involved with, is it's been a while since someone's usually taken inventory and just said, what are the recurring spends that we have, every month by vendor. So one of the first things I love to do is just pull an expense by vendor report. Usually this is very easy to do in whatever, kind of accounting software system you're using. And it's just pull an expense by vendor report and look at it by month and just see, okay, where's my spend going? Now, some of these might be annual licenses too, but at least getting a vendor report over the last year, that's going to tell you so much. There's gonna be a lot of insight in there, and that's probably step 1. Step 2 is just to identify or to evaluate your usage. People leave, right? We talked about headcount churn. People leave. Well, a lot of times the last thing we're thinking about is, we need to go reduce our number of seats on, XYZ software. It's also a great time to go evaluate, are people still using it? Someone might have championed the software 6 months ago. That person maybe is gone, and then that department has no idea that even software is still turned on. So is it still driving value? And then from there, I think you can really start to identify, are there any duplicate or overlapping tools? I think that's another question you can ask. And then if there's a tool that you're like, I like it, but it feels too high, just feels like it's, then that's a great opportunity to go negotiate and see if you can get a better rate, if with that company. And you can use market data. And if Spendflo does that for customers, they go through and negotiate on behalf of the customer for SaaS spend. And then the last point there is just do this on a regular basis. Do it quarterly, at least semi-annually. Think of it as spring cleaning for your subscriptions. That's the best way I can put it.
Yeah, I've actually started calling the zombie SaaS, in that they just like keep going. They keep, and even if nobody's there, like the lights aren't turned on, like they just keep going. So like trying to find that in our P&L and get rid of it if we can, and also just making sure that people really like the tools that they're using, and if there's any opportunity to change it out, kind of almost like getting a review from them on like, hey, is this a 3 out of 5 or is this a 5 out of 5, and should we be keeping this, or should we be thinking about replacing it? And just, but I think, there is a propensity in business to just keep doing what you're doing, especially during times of downturn. Like, okay, I know what this is. I have a sense of it. It gives me security to keep doing what I'm doing, but that may not be the right thing to be doing. And we may need to think about it differently and start making changes. So by asking people to like, hey, is this the right tool? Is this what we should be using? Is there something else that we can be using? It really just kind of like sparks the thought of how do we do things differently? And it can have like, beyond just the tool itself, think about what the business is doing. I feel like I read some random like Business Insider article yesterday that essentially they asked the company, hey, what are the top 5 things like that are like burdensome controls that you don't think are helpful? And the company came back and they did an analysis and they got rid of like 40% of the like checks that they were doing, but still maintain the control process. It became way more efficient because they were doing things because they were, at some point somebody thought it would be a good idea, but it wasn't necessarily helpful to the business anymore. So really just like, killing those zombies.
Might have to steal that, Rob. Zombie SaaS. I like that.
Zombie SaaS and spring cleaning.
Yeah.
Good terms. And by the way, the founders at Spendflo, I think, were really frustrated with this in a prior life. They've got a pretty interesting way of automating the ongoing management of these SaaS expenses. So something to check out if that's an area of interest for those in the audience. So let's shift gears a little bit and switch from profit and maybe talk a little bit about cash flow. We've gone from the extreme of late 2021, where it seemed like there was an infinite supply of venture capital and record low interest rates, to now, you really have to have some pretty amazing financials to go out and do a big round. Rob, maybe give us your perspective, because you've been working with a bunch of these companies through that transition. Yep. Obviously times have changed. Like, what are some of the things that you're advising people to do to keep an eye on cash runway and cash flows and all that?
No, that's a good point, Steve. I've actually been surprised at how much it has changed over that period. I mean, not necessarily surprised, but like I would say even the before times, even the 2015s, 2016s, the capital raising is probably equivalent from a dollar perspective to that right now, but it feels so much lower because we just had this heightened sense during the 2020, 21, even in early 2022. But I would say that cash management is top of mind for VCs, for founders, for CFOs. And it's more so than it has ever been in the past. And what I'm seeing most clients do is do weekly cash forecasting. In specifically, just breaking down your expenses by week, having an Excel that goes out for at least 2 or 3 months, potentially up to a year, of just like how that cash is going to be used and how it's going to burn down and how with each payroll it's going to be. I mean, typically I would only see that before if we were like, approaching like a balloon payment on a loan and the bank was asking for it, or you were getting close to a fundraising round and wanted to make sure that you kept an eye on cash and didn't run out before that round closed. Now, even the companies that I've raised recently are just doing that as part of their like continuous business practice. And they're rolling that into the whole, finance 12-month forward monthly rolling forecast. But like, definitely doing that, the weekly understanding of the cash flows.
Yeah, I would agree. I mean, I've seen more of the same thing, Rob. Definitely more of a weekly cash flow. I would say a lot of my experience has been with the customers who kind of are getting close to that dwindling down point, where they see the kind of the light ending. But I've seen it definitely more widespread as well. It creates a lot more opportunity for finance to deliver value too. So that's helpful.
So adding on to that, Stephen, is there anything else kind of basic, like if you could recommend, 2 or 3 things that everybody should be doing to get their arms around cash flow and stuff, and any other suggestions?
I think the biggest piece here is I kind of think through like the front door and the back door. So what I mean by that is the front door is like managing your AR and AP. And so that's, you know, people paying you and you paying people likewise. So I know a lot of people, I've talked to actually a lot of founders lately who just say, hey, I hate having a bill. I just don't like having a bill outstanding. So they just pay it right away. Whereas they could have waited another 30 days or 60 days even on those bills. It was just the idea of like having it outstanding. And effectively what we're doing when we do that is we're letting we're being the bank for our vendor. Now it's, you know, it creates a good vendor relationship, but you're fronting the money for them, right, for that period of time. And so you're going to have to, that eats into your cash flow. Same thing with AR. Someone who doesn't pay you on time or even is late, they are making you essentially be their bank for them. And so I think just having someone inside the company who really is like has full ownership over AR and AP, I've noticed just making that change has a dramatic impact. And just even regularly looking at reports can really, really sharpen up those processes. The backdoor, I would say, is what I would is churn. And we see the top line sales number, but we don't see all the time the leakage that's happening out of that. And so if you're churning customers, that's revenue straight out the back door, but it's not as obvious. It's not as obvious because it doesn't always show up, you know, like right there on a line item on a report. And so I think just digging into if you are seeing churn issues, why is that happening? Is there corrective action you can take? So those are some key areas I'd focus on.
And just adding on to your front door concept about AR and AP, like, are there any kind of strategies from a contract standpoint you're advising clients, or you've seen people do, like negotiating, you know, with customers to bring cash and receivables in faster, or on the flip side with vendors to kind of extend payables?
Yeah. Oh yeah, feel free, Rob, if you'd like to.
I was gonna say if interested in either of your perspectives.
Yeah, I mean, I'm definitely every time we have an opportunity to negotiate a contract, I'm always asking for better terms. And so whether that's, you know, net 60 on the vendor side, or, you know, upfront payments, or pulling forward payments on the customer side, we're continuously trying to do that. Like, you know, there's definitely a push and pull there. Like everybody's trying to do the same thing, and like you end up meeting in the middle, and maybe that's exactly where you started. But you know, if you're able to do it, like if you're able to get net 60, you're buying yourself essentially a month's worth of cash flow. And you know, that can be better, and depending on the industry that you're in, that may be, you know, that may be normal terms. Like I have a couple of healthcare SaaS companies that I work with, and everything in that industry is net 60 terms. So if we were at one point we were paying net 30 and we shifted to net 60 just so we could match the terms of our vendors, and we weren't floating that month's worth of cash flow. I would say also that you need to stay vigilant on those late payers. You know, a lot of people put late payment terms into their contracts. I don't see them enforced a lot, but I think, you know, given the situation we're in, I would expect more attempts to enforce those. I mean, to a certain extent, as a CFO, I never really pay them, even if I am a little late. But you know, I do everything unless they're shutting off my internet, and in which case I'll pay them. But otherwise, you know, it's kind of a forcing function just to encourage payment on some of the laggards. Sometimes just adding that interest penalty or whatever it is that you have in your contracts. And if you don't have it in there, definitely build that in. Yeah, I don't know. I hope that's like kind of useful.
So we're going to segue to the third segment, which is on growth. But I just wanted to remind the audience, feel free to type questions into the Q&A panel. We'd love to get a few real questions from the audience. In the meantime, I'll keep going through some of the ones that I prepared. So let's shift to talk about growth. Maybe we'll start with new customer acquisition. You know, everyone I talk to, everything I read, you hear, you know, purchasing cycles are taking longer. People are being more cautious and considerate about where they're spending money. You know, I hear from our sales team all the time, you know, the CFO is involved in every decision, which is probably the way it should be normally, right? Any strategies that you're seeing your clients taking that are helping to kind of just bring deals in faster?
I'd say, you know, bring deals in faster. Like it's the same thing that it always has been, which is addressing their objections and understanding the customer and listening to what they're saying. I think, a lot of customers are concerned with cash sensitivity and those outflows, and kind of, referring back to our immediately previous conversation, sometimes you can get a deal over the to close it down, as if you're giving a little bit on the terms more than you normally would. So if they're sensitive about cash, maybe you give them a net 60, maybe you give them an opt-out period so that they can be more comfortable and alleviate their fears before they jump into the product. 15-month deals, so 15 months versus 12 months, and making sure they're getting a lot of value and making them feel like they're getting something for free and that you're giving, just to close out the deal and get it done, so you can bring it into the quarter, to the year, whatever it is, and that way that it's one less thing that you have to chase down the next quarter. Recommendations here always go for the opt-in or opt-out versus the opt-in. So sell your contract and say okay, you have 3 months to test it out, and if you don't like it, you can leave. But the opt-in is so much harder because you're essentially selling the deal twice. So always go with that. And then automatically convert that to a full-time contract. If you're doing a separate trial period, automatically convert it to a full-time contract. I think most people are used to it in this environment. I mean, that's typically the way SaaS companies have been run for the last 10 to 15 years. And so to a certain extent, if they're not noticing that and they let it expire and it rolls into a contract, that should be their expectation. And I think you have a better than normal chance of actually getting collected on that and giving them the product. And it may take some reconvincing on the customer success team, but definitely do what you can to lock them in as soon as you can.
Good advice. So I imagine we have a lot of folks listening that have end of quarter coming up here in the next 24, 36 hours. So extending the payment terms, offering the opt-out, good options. By the way, for those of you that are interested in SaaS trivia, we've been doing some analysis on the 150 or so public SaaS and cloud companies. And as you might expect, the overwhelming majority of them have a fiscal year end on December 31st, but there's about 20% that have a January 31 fiscal year end. So there's a lot of folks that have another 32 days probably to close their quarter, which is good for them. But moving into the next topic, Stephen, let me get your perspective on kind of sales and marketing expense. Again, it's kind of been we've gone from one polarized extreme to the other here in the past 18, 24 months where, it was can't possibly hire salespeople fast enough back in 2021 to today. We're kind of questioning every expense in the marketing budget. How from a finance standpoint, though, how do you look at sales and marketing and kind of think about whether we've optimized budget and headcount? Are we spending the right amount? Are we not spending enough? Are we spending in the right areas? How do you think about that?
Yeah, I think you probably hear a common theme for me today, and it's any area we can look at and kind of analyze from an efficiency standpoint, I think is going to be helpful. So from a marketing standpoint, Rob talks about how digital advertising is one of the top, areas of expense we see on the P&L. How long has it been since we've really really truly dug in and said, no, really, is that dollar that I'm spending on Facebook, is that really truly generating a better return on ad spend versus my Google or my LinkedIn or, you name whatever the channel is, right? And so doing some sort of having someone, do a channel analysis of, we spent X dollars in these channels the past 6 months or 3 months. Here's what it's returned. Whether that's, you can slice that up any number of ways. It could be leads, it could be deals closed, it could be any number of things. And so, and then even looking by channel, what has your churn been from that channel? I think just getting down into are we targeting the right channels? And then what I'm seeing some people do is maybe turn off maybe that third or fourth channel that hasn't been as efficient or as effective. And then let's funnel money into these two that they're knocking it out of the park. We think we're leaving money on the table there. So I think that's one great step you can do. The other step, I saw this done really well at a previous startup I worked at. They evaluated and kind of studied the top SDRs and BDRs and like where they were spending their time and what was like really creating the leverage for the top performers versus the medium or the bottom performers. And so this is a great time to sit down with your top sales team and say, what are you doing? Like, how are you, like, what activities are you doing throughout the day? Like, what activities are you driving? And then do that with someone in the middle, someone at the bottom. And that could be a great way to kind of retrain or kind of nudge the whole sales team into more efficient activity if there's a couple nuggets there that the top salespeople are doing a little differently. So those are a couple of things that come to mind.
Yeah, and as a marketer, I would actually agree with you on the advertising. That's the first place I would typically look if I needed to reduce budget. And the demand gen people hate it, but I'll come into a new environment and say, let's just turn off the Facebook ads for 30 days and see what happens, right? You guys don't have data, like, let's see what happens. And usually the sky doesn't fall as they lead you to believe it will. But anyway, we've got a bunch of questions coming in from the audience I want to get to. So one last question here on this growth area, and then we'll jump to the kind of the audience questions. But expansion, I've been a lot of these early stage high growth companies, and expansion is always something that just doesn't seem to ever get enough attention. You know, the studies I've seen, it costs you 3 times as much to acquire a new customer as it does to sell more to an existing one. Any strategies you're seeing working in this environment with upsell, cross-sell, any kind of quick wins that you would recommend? I know, Rob, you've had some really creative strategies you recommended to Ordway. Maybe you could start us off.
I think building in the capacity to expand in your contracts in the beginning is important. You know, like one thing that I've done recently with my companies is set the expectation that there will be a service fee in the following year. A lot of times, like, support is there and we provide it regardless, but setting the expectation we're going to waive it in year 1, and then in year 2 we're going to start charging that fee. So one, it feels like they're getting a discount in the beginning. The risk in the beginning is lower because they're not paying for it, but then kind of setting the expectation that, oh, there's going to be a 10% or 15% upcharge in year 2 because we're going to add that in. And, you know, it becomes, to a certain extent, it's a negotiation tactic. Like, if they push back on that, well, like, you know, like, as opposed to them pushing back and saying, like, we don't really value this, it's too expensive. You're like, okay, well, we'll waive the fee again this year, and you maintain that ARR versus, you know, the opposite, which is like, okay, it's too expensive, but now we're going to have to take some contraction. So just setting the expectation that there will be increases. I mean, I also, you know, try and build in at least a you know, an inflationary number to almost all my customer contracts. I think that's pretty much the expectation. A lot of times, from a CFO negotiation vendor perspective, I'll push back on those, see if I can get them to waive them for the first couple of years. If they don't waive them for the first couple of years, get them down to like 3%. A lot of times we'll start at like 5%, and a lot of people don't push back on those. So to a certain extent, if you can build them in from a customer perspective, that's great. Yeah, I think those are the ones that come top of mind. Oh, I guess the other thing I would mention is professional services. If you are doing extra work for customers, make sure that you're billing for it, either in buckets of time, like, okay, 10 additional hours, and we'll provide that, or you know, just setting up time and materials and doing it a month in arrears. I think it's, you know, cash is cash, and it may not be adding to the ARR, and may not be directly influencing the enterprise value, but you're also not giving stuff away for free. And customers value things more that they pay for, and they don't value things that they don't pay for. So if they're sucking up service time or professional services or professional support, make sure that you're charging them, and you're charging them a fair rate to do that. And the one thing I will mention, since Ordway is a revenue recognition system, it handles this well, and all these other complex revenue recognition issues that you can get into with contracts. Make sure that you're accounting for those correctly, know how you're going to account for it, and make sure that you're recognizing it correctly, so that when you get into those annual audits, it's all ready to go and you're not making adjustments. Okay, good. Well, we've got a bunch of questions that have come in. The question is, how can the finance team help with reducing churn? What is the role that you would recommend that you play?
I can kind of take a shot here at the first piece of it. For me, what I've always kind of done is been one of the people on the team that have like tried to dig in and say, okay, our revenue, we know there's new sales coming in. Why is our revenue staying flat? Like that's a flag number one, right? So just like taking a look and really understanding the revenue numbers and what the whether it's going up or down or staying steady is one part of the story, but then like what's going on beneath the surface? Like what are the drivers there? And so I think that's a great way finance can at least raise the flag of, hey, I think there's something going on here. Depending on the size of the organization, you may have someone already kind of keeping an eye on customer churn. But at smaller organizations, that may not be the case. And so, even what I've done in the finance function at smaller organizations is done some of the analysis, customer analysis of, well, we had this many customers last month. And a lot of programs now, like, your Stripes and a lot of billing softwares, they have automated, churn cohort reporting. It's an incredible tool. So if you have churn cohort reporting already built into your billing software, use it because there's gold in that data. But I think that's just where I would start. I think that's how the finance team can help, is just raising the flag, and even kind of digging into some of the data. You might not have all the answers. In fact, you probably won't have all the answers in finance, but you can put that question to someone closer to the customer who may have the answer.
Yeah,
By
I
the way,
concur.
ahead.
I think finance's role here is to be the connector. And I think that a lot of times there's a loose connection between kind of revenue generation, so maybe account management, customer service, and engineering, dev, whatever it is. Like dev and engineering are probably going to be the biggest influencers of that churn. Like typically when people churn, it's a product issue. It's like, as much as you want to be able to control it and customer success, customer support, like that's a Band-Aid. And so the real question is, like, what are the things that the company can do? Make sure you're analyzing that churn, put them in buckets. You're not going to save them necessarily, but what you are going to do is find out what is driving it. And if you find out what is driving it, you can help your current customers both stay customers and potentially expand. If there's like a feature that's missing or a particular bug that's frustrating people or that people are leaving, make sure that you're connecting that churn to what the business can be doing to ultimately drive that future revenue. And finance is kind of the intermediary between those things. And sometimes it's the driver too, because customer success is always going to be like, we need these product fixed. We need dev to do these things. And dev's always like, okay, I have all these things to do. I'm focusing on this new product, or I've got this thing that we're working on in this sprint. But finance can be the driver of like, okay, this is the priority thing that we're seeing the most of a churn. And guys and dev, I really need you to work on this or fit this into the next sprint or put this on the roadmap somewhere so that we can address this issue and combat this churn.
And you can help in finance. We can help quantify. Here's what this churn is costing us. Here's what this
Absolutely.
one churn reason is costing us on an annual basis. That's a powerful narrative, I think.
Great. Next question was, how do you think about what the right level of sales and marketing spend is in a SaaS startup? Any benchmarks or advice that you would offer there?
Between 30 and 50% of revenue. I mean, like there's so many sales benchmarks out there. Like I would say, like, rule of thumb, it's that if you're a high growth company, it should be closer to 50%. If you're a lower growth company, it should be closer to 30, maybe even 25. I think there's the sales magic number. Google that one. It'll tell you, like, it'll essentially take your CAC, compare it to your current sales in the prior quarter. And if it's greater than 1, then you're under investing in sales, and your business technically supports more investment in sales. And if you're not doing it, if you're under 1, it means that you're over invested in sales. You may need to cut back on the sales team, or they need to sell more deals really fast. But yeah, there's a lot of metrics out there that address that. I mean, making sure their LTV to CAC ratio, so long-term value to customer acquisition cost, is above 4 at least, which typically means, over the lifetime of the deal, it's going to earn itself back, those costs back 4 times. Making sure payback period is less than 12 months, especially in non-enterprise SaaS, like more customer-facing SaaS, making sure that it doesn't take too long to earn back that money. Making sure all those ratios are lining up. And if there aren't, like, figure out which one is driving the difference. It may be your gross margin, and you're not making enough per deal to drive the long-term value. And like I mentioned before, like when we cut that bottom performing plan, that actually drove up our LTV, and our CAC was then justified, and we're getting 4 and 5 to 1 versus 2 and 3 to 1.
I would agree with everything Rob said. I think the other question I would ask on the flip side of this is, what is my operation capable of supporting right now as well? So if I go like blow it out of the water with my sales and marketing, am I going to create this like giant bottleneck on the operations side, and then I'm going to have all this churn? So I think it's marrying the two. And does my, once you kind of land on what feels right for my stage of the company, and like looking at the ratios, can I then support that if it all comes through as I expect?
Switching gears, I want to go back to something we were talking about earlier on the expense reduction side. And one of the categories you guys both mentioned was in the top 3 was this cloud infrastructure, AWS, Azure. Any advice for how finance teams can kind of get their arms around understanding that it's kind of a black box? It's difficult to get insight to. The engineers don't necessarily want you looking into there, but it's a lot of money. Any recommendations on how to approach that?
What I've done, at least the approach that I've taken, I don't know that I've gotten this completely right. I think there's always room to learn and grow in this area, but I think what I've always tried to do is just highlight it. Whether it's on like a monthly, the monthly kind of financial review with the executive team. Hey, I noticed, here's what your cloud spend has been over the last 12 months, and I've noticed that over the last 3 months it's increased 20%. So I saw this for one customer, I called it out, and it was like, why would it have increased 20%? There's no reason it was. And then it kind of put the person kind of over that area of the company. It kind of, the takeaway was, I've got to go dig into this. I don't know why that would have jumped in. So I think from a finance perspective, we can again raise the flag, answer the question, or ask the question. But then internally, there are tools too. I know, like, I believe Azure has a pretty good tool that you can kind of evaluate it. But the usage and where it's going. But I think what happens is, who's keeping an eye on it? So it comes down to, is there an internal champion or an internal owner who really is keeping their eyes on that? Because me in finance, I'm gonna have I'm gonna have no idea, because that's above my pay grade. That's the dev team. They're on a different level, so they're gonna know a lot of the technical details. So it's got to be someone closer to that, I think, that can really identify the gaps.
Yeah, I'm surprised that I haven't mentioned this already, but I think the number one takeaway, if you take away nothing else from this webinar, is that every expense should have an owner, one single individual owner that is responsible for that contract. So if it's Salesforce, it's your sales leader. If it's Zendesk, it's your support team or your customer success leader, whoever that is. Every single item on your P&L should have an owner. They should be assigned for it, and they should be responsible for it. And you, as finance, your job is to report out to them how they're doing against that item. And here, I find that because cloud kind of lives across systems, like a lot of times it's the dev team, but it's actually influencing gross margin, there tends to be lack of ownership. And so most of the time I put the ownership on that directly on the dev team, because they have the biggest influence on it. If the company's big enough to have DevOps, maybe the DevOps team owns it. If there's a technical CS team, maybe they're involved, but more often than not, it's the dev team leader. And in my executive to executive conversations with that person, I'm like, this is one of the biggest drivers of the value of this company, and we need to do everything we can to make sure that this is within reason and as low as we can get it, so that we look good from an enterprise perspective, we look good from an LTV perspective. Like, this is one of the things that, again, influence the most and actually have a tangible result. A lot of times building product, you don't know the outcome, but if you can reduce cost, it's definable, and it can absolutely influence the business. And a lot of times they get excited about that. They know they can have a direct measurable impact.
I want to highlight one more thing too. Every dollar out the door is still a dollar out the door, but the dollars out the door in your cost of goods sold can help make the fundraising effort a lot easier, a lot harder. So if you can be more efficient, that gross margin number is even like a couple points higher. That only helps you in conversations with investors, and it only helps you stand out. And so I think there's even more of a highlight on costs that sit in COGS, especially that are just kind of big buckets like cloud spend.
I think we got time for one more here. I'm going to try to squeeze one more in here, and it's around incentives around collections. And, I guess just in general, how do you get the business motivated to bring receivables in, right? Is it just the job of finance? Does customer success need to play a role? Do you hold sales commission payments until the money comes in from the annual invoice? How do you guys think about the role of collections, both within finance and outside?
I would say, so I'll take the lead here.
Yeah,
I would say collections is a team effort. And a lot of times the teams don't want to be involved, but like we need them to be team players. So if that's, I know CS doesn't want to be like the bad guy and do the collections. So let finance lead and be the bad guy, but they have to be the good cop. They have to be the follow-up and make sure that the customer is actually responding to finance, because nobody likes to respond to finance. I would say, like, depending on what stage you are, definitely like commissions can be related to collections. I don't think that's uncommon. It's a good cash flow management deal. I think it was hard to get people during the previous 12 years. Like really good salespeople didn't want to be bound by collections because they didn't have to be. I think more and more companies are moving towards that because one, they're having harder times collecting, and also two, just from a cash, like, we got into the situation where we had this incredible quarter, like just knocked it out of the park, and then we had all these commissions due, and we hadn't collected any of the money yet, and we're like we have this incredible success, but we're having this like cash crunch right now because we've had so much success. And so it just makes fundamental sense to tie some of that to collections. Now, would I do incentives? Would I give somebody like 1% of the collection? I don't know that I'd go that far. I mean, I'm a firm believer in that people that want to do the work will do the work regardless of the incentive. And the incentive really a lot of times just drives people on how to get the incentive, not necessarily to complete the work. And so they're going to take the path of least resistance. And that may not be in the best interest of the business. So they may call up the customer and harass them until they get payment. Great, we've gotten payment, but we're also really pissed off the customer, and that doesn't do the business any good. So my personal opinion is not necessarily tied to incentives, but be thankful, reward them with praise, and if they bring in a collection, make an announcement to the team, or keep a tracker of one of the thermometer things, like collections we've made this month, whatever it is, like non-financial incentives, I find actually can be more encouraging.
I'm sure there's a SaaS app they could buy that would do that thermometer.
If not, someone's going to go build it right now.
Yeah.
Well, I actually like what you said, Rob. A lot of we always celebrate, in Slack. It's like, hey, we just got a new deal. We just closed a new deal. It would be an interesting to kind of add to the culture. Like, hey, we just collected the money for that deal. That's one way to help incentivize it. And I think tying at least one, giving somebody an OKR or a metric that is at least on their radar. Again, like having some owner, at least one point person who owns that number. I think also helps. And then, if they don't fulfill that, they're letting internal, customers or internal colleagues, they're letting them down because sales commissions might be tied to that or what may be. So.
Good. Well, I want to close out here because we're almost at the top of the hour. Thank you guys so much for taking an hour out to spend with us and share all these insights. Hopefully everyone in the audience found it valuable. As I mentioned earlier, we will be providing a replay of the recording of the session. Thanks again to our friends at Spendflo for hosting this and sending that replay out here early next week. And good luck to everyone that's got quarter end here in the next couple days. And for those of you that don't, hopefully you get to enjoy a long weekend. Thanks, everyone.
Thanks, everybody.
Thanks, everybody.